And our featured guest is Jack Ablin, the Chief Investment Officer over at Harris Private Bank. Jack, got to start with you. We got a rally underway. What do you make of this?
Well, I think it was probably based on the back of the favorable ISM report on the services side, and drilling down there, we were able to find that the employment survey was also pretty positive. We put a research piece together that suggests that maybe things are turning, and that if ISM continues to lead the unemployment rate as it has in the past, that we could actually see a peak in unemployment pretty much sooner than we thought.
What specifically, though? I mean, because you know a lot of other folks are pushing that it's still going to be a very tough labor force well into next year. I mean, what specifically gives you that optimism?
Well, there's a component of the ISM services survey that looks at employment, and that's starting to improve. Generally, the ISM employment survey has been a pretty good leading indicator. It peaked just at about the equivalent point of where we are right now, and it's starting to pull back in terms of unemployment. And that would suggest, if as I said, if it retains its predictive power, as it did on the way up, that would suggest maybe we'd start to see an easing in the unemployment rate, actually having to come down over the next couple of months.
Do you think that people have been too negative? I mean, this two-week slide, people have focused more and more on employment. We had an admittedly worse than expected number on Friday, but isn't this the way it happens after every recession? I mean, if you look at 81, 82, you're seeing unemployment climb into the end of 83.
Yeah, I mean, it's certainly at this stage of a cycle, it's very easy to be bearish and it's easy to be negative. And what we find is that the average investor is pretty skeptical and, incidentally, hoarding a lot of cash. So, you know, given that we would likely see some economic tailwinds, albeit prompted by a lot of stimulus, combine that with a broad skeptical investment base and a stockpile of cash, it's possible that if we do start to surprise these skeptical investors to the positive side, that we could see more of that cash coming into the market and actually fueling a rally incrementally higher.
When do you typically see that? Because we see unemployment climbing after recessions for typically, what, 9 to 12 months, right? Continuing to climb after the recession's over. Do you see
2 quarters.
Do you see typically cash on the sidelines being hoarded as much after previous recessions as well?
Yeah, I mean, incrementally, Matt, they have. I have not seen cash hoarded to the extent it is today, and largely we're seeing it in these 0% interest rates. The fact is everyone is trying to get through that door at the same time, and as a result, you know, there's no yield there. So I think as investors slowly become more sanguine on the outlook, perhaps they may need a little more evidence from earnings or some other economic data, perhaps even a positive or at least a more favorable earnings report. You know, that could actually help move money away from this, you know, mattress mentality.
You know, Jack, I've got a viewer writing in. He says, you know, today we have no real important data and the market drifts upward. It's as if the bad economic news from last week is just simply forgotten. I mean, the jobs report really kind of shook investors a little bit. We've had some other negative data points. I mean, where are we in terms of the economy at this point?
Well, you know, what I've said before is, you know, we're running this marathon on donuts, meaning that we're, you know, we're fueling this growth with fiscal stimulus, and that's bad news because that's not that sustainable. The good news, though, is we've got 10 more donuts left in the box because we've really only committed roughly 10% of what we've announced, at least on the stimulus program. So that would suggest that this these tailwinds should be able to propel us well into next year, at least through the second quarter of next year. And I think that by itself will likely catch most cautious, skeptical investors on their heels.
Hey, Jack, let's bring you back into this. The earnings, they're just about to get underway. Is that going to provide significant momentum here to equities in your view?
Well, again, the earnings expectations are consistent with this dour outlook among investors. The fact is that analysts are anticipating earnings to be down more than 22% year over year. And, you know, my sense is we're going to continue to beat on certainly on the bottom line. The question, though, is, Carol, will these companies start to show some top-line growth? Are we going to start to see, at least on a sequential basis, are we going to see revenues increase? I think we will. Year over year, it still remains to be seen. But I will say that let's start looking sequentially first, and then look for year-over-year gains as we move into next quarter.
Let's get back to Jack Ablin, Chief Investment Officer of Harris Private Bank. So, Jack, when it comes to the commodity trade, what's your thoughts here? Because we've certainly seen a bounce off lows.
Yeah, we went back to neutral in commodities from a zero weighting middle of last year. Probably went back to neutral, I'm going to say, in April or somewhere thereabouts, figuring that the coast was clear. But we still haven't gotten strong enough signals, Carol, to suggest that we're in a sustained bull market in commodities. So we just sort of went back to neutral just to have that position. Generally, what we like to look at are real rates on T-bills. Here, we'd like to see if T-bills offer a rate that's far in excess of the expected inflation rate, then financial assets or T-bills are a better deal. And there, clearly, if real rates on T-bills are negative, given that the 5-year expectation for inflation is about 1.3 or so, and of course, T-bills are less than 1%. So that would suggest that investors looking to hedge inflation would be better off owning real assets versus financial assets. The problem is, Carol, we're not seeing a real trend in the inflation rate. So we're not in any rush to necessarily jump onto that commodity bandwagon yet.
Are you, though, not concerned, even a little back corner of your mind, about real inflation hitting us much harder after so many trillions of dollars of government money has been built into this bailout and printed up at the Fed?
Oh, no, Matt, you make an excellent point. I mean, the fact is, we've got this, this spring that we've wound up in stimulus and money supply and in just about everything else. I mean, the big offset really is velocity. The fact is the banking system is not lending, and so that's really drawing all of that money supply in like a black hole. Now, the fact is, if we start to see lending tick up or velocity pick up, then I'd say our inflation expectations are going to rise. But for right now, with slack capacity, with high unemployment, with no velocity, my sense is we're going to have at least a 2 or 3 year buy on inflation. But I do believe it is an eventuality, the way things are setting up.
All right, Jack, thanks so much for joining us.
Jack Ablin, Chief Investment Officer of Harris Private Bank.